Hey everyone, it's Kirk here again at Option Alpha. So in this video, I want to talk about options trading in your IRA and go through 3 risk-defined strategies you can use and how to find potential trade ideas. So options trading in your IRA is just a little bit different, but here's what you need to know. First, it's a really good idea to trade options in your IRA because IRA accounts are tax favorable. Whether you have a traditional IRA account or a Roth IRA account, it's favorable for taxes, which makes them great for trading options long term. You're not going to use this obviously for any daily or weekly income, but you can use it for long-term wealth building, and that makes a lot of sense. The second thing you got to know about options trading in an IRA is that all positions have to be cash secured or defined risk positions. That means no naked positions. You can't do short calls, short puts. You can't do straddles and strangles because those are undefined risk positions. Everything has to be a defined risk position, which actually makes a lot of sense because you should generally be trading defined risk positions anyway, unless you have a super large account. So for most people trading in their IRA, it's going to make sense anyway that you trade regular defined risk positions. One final restriction that you have in an IRA account is, of course, you cannot sell short stock. Most people don't do this anyway. Most people don't even know what selling short stock is. But again, with options, you can take bearish positions via some of the things that we'll talk about today, like bear call credit spreads, etc. And that gives you downward exposure to declining stock positions or declining ETFs, which is great anyway. So the fact that you can't sell short stock shouldn't really be an issue, and most people don't do it, or you shouldn't be doing it, again, unless you have a super large account. Now, the other thing you have to watch out for with IRA accounts is just your options trading approval level. Generally, trading approval levels go up between levels 1, 2, and 3, where level 1 is covered calls and cash secured puts. Then you got level 2 options trading approval level. That's usually long options, so you can do long options or long option spreads. Level 3 is where most IRA accounts should be. If you're not at level 3, you want to try to get to level 3 or whatever the similar level is for your specific broker. Again, all different brokers have different intricacies inside of their levels, so you want to check with your broker on that. But generally, level 3 is approved for credit spreads, iron condors, iron butterflies, etc. The one that you're not going to have in an IRA account is you're never going to have level 4 trading approval. Again, that's going to be your naked and uncovered positions, so naked puts, naked calls, etc. And the reason that you don't have those available in an IRA is because those specific strategies have undefined max losses and undefined risk. So for example, just a short naked put option, you take in a big credit, but you have this undefined max loss. There's no point at which it's kind of defined. On a short put, I guess it's kind of defined at the zero barrier, but if you go to like a short call, there's an unlimited amount that you can lose to the downside because theoretically the stock can go up forever and continue going up in price. So you have this max undefined risk on the downside. So this is what makes it a little bit different for IRAs. You just have to have strategies that you're trading that have defined risk. So today I want to go through 3 of those that you can use inside of your IRA account. So the first strategy that you can use is a bull put spread. This is also referred to as a short put spread or a put credit spread. You can hear this different ways, but it's the same exact strategy. And so effectively what you're doing for this strategy is you're selling a put option, so just like the example that we had before, but you're also buying a put option at a lower strike, and you're doing the spread between them. That's why they call it a bull put spread, because you're buying and selling option contracts, and the difference between those creates what's called a spread. In this case, it's a $5 wide spread. So we have a $5 wide bull put spread. We're selling option premium. We're using a little bit of that premium to buy ourselves protection. What this effectively does is it gives us defined risk on the bottom side. So that means it's eligible and allowed to be traded in an IRA account because you know exactly how much you're going to lose. And you have defined profit potential on the top side. This makes all the numbers and calculations really easy. So again, a bull put spread is also known as a short put spread, short put credit spread. It's basically when you sell a put option and buy a put option at a lower strike in the same expiration. Again, you're going to do this for a net credit. So all the buying and selling that you do, you're going to do this for a net credit, which means you get paid to enter this position. So if you're doing this for a net debit, that's not a bull put credit spread. That is a debit spread. You don't want to be doing those necessarily unless you have a really strong opinion on the market and you want to kind of buy into options trading. But generally, the better choice is to do the credit spread alternative. Again, it's an option selling strategy that is bullish with a little bit of margin for error. That's why I kind of like doing these strategies, because you could be wrong on where the stock goes, but still make money on the trade. So to use our example from before, so that if this is our payoff diagram, this would be kind of how you'd visually think about a bull put spread. So wherever the stock is trading, you're going to sell, let's say, the 50 strike put, then you're going to buy the 45 strike put. That gives you defined risk. So it doesn't matter how much lower below 45 the stock goes. Stock could go to $0, could go to $10, $14.10, whatever. It doesn't really matter. That is defined risk. You know exactly how much you're going to lose below 45. Then in between here, you've got some variable profits and losses. Your break even's around 49. And then this is the out of the money range for this position, which means max profit. So if the stock stays up or continues to trade sideways, you make the most amount of money you can make on the position. I like these strategies because, again, if the stock goes up or stays sideways, you still make money. So if the stock trades sideways, you still make money. If the stock goes up, you still make money on the position. You can even make a little bit of money on the position if the stock goes down and stays above your break-even point, and that gives you some variable profits in there as well. So the second strategy that you can trade is the opposite version of this one. So it's just on the opposite side. This is a bear call spread. So it's also referred to as a bear call credit spread or a short call spread or a call credit spread. There's many different names for it. Again, it's the exact same strategy. It's just flipped completely to the other side. So now what you're doing is you're selling a call option at a strike price, let's say 50, and then you're buying a call option at a higher strike price, again, to get that defined max loss on the position. So this is what we're after in IRA accounts. We want to make sure those positions have defined profit characteristics and risk characteristics. This is what you get when you do a call credit spread, is you get that defined risk on the top side. So what you're hoping for here is that the stock either doesn't continue moving higher, moves sideways, or goes down just a little bit. So again, these are also referred to as short call spreads, short call credit spreads, call credit spreads. It's all the same things. All you're doing is you're selling a call option, buying a call option at a higher strike with the same expiration. Again, just like before with the bull put spreads, we are going to be doing this for a net credit. That means that we're taking in money on this position. That's what we want to do, sell options net. And again, this is a neutral to downward strategy. So this one's kind of cool because, again, if you have a stock that's going up and you think that the stock might continue moving lower, you could do something like this. Let me just actually adjust the chart here so it's a little bit more relevant to where you might enter the position. There we go. So the stock is here and you think, oh, maybe the stock goes down or doesn't continue going up, etc. You enter this position, you'd sell a call option at say 50, buy a call option at say 55, and you hope that the stock doesn't go above 55. Now, if it does, again, same rules apply, just in the opposite of the first example that we had, which is that the stock could go up forever. It could go up to 120, it could go up to 500, doesn't matter. You are still capped at your same max loss that you initially had when you got into the position. That's the key for this, because then it's allowed to be traded in an IRA. Also, it's just good trading practices to kind of cap those max losses. It makes sense. It makes all the numbers make sense. And you also don't have these lingering loss potentials that go out there in case of black swan events. So if the stock does go down, let's say the stock actually goes up maybe a little bit and then it starts to come back down, this is what you're looking for, is you're looking for something that even if it goes up and if it comes back down, it might end up going generally sideways, maybe even a little bit higher, but you still want to stay below that break-even price. In this case, it's about 51. If we stay below break-even, we go sideways to down, we make some money. If we're totally wrong, we've got some variable losses in here, and then again, we're capped at our max loss. So these are two good strategies you can start with, which is the bull put spreads, and then you got the bear call spreads. Both of these you can easily find trade ideas for right now inside of Option Alpha. So let me show you how to do that. You're going to want to go over to trade ideas inside of the OA platform. So on the left-hand side here, click trade ideas. And what that's going to do is it's automatically going to analyze trading potential all day, every single minute, millions and millions of trades through the day. And what you can do is you can then filter for the criteria that make the most sense for you. So I've already included a couple filters here. I'll add links directly to these pre-filtered sections so you can just check out new ideas for whenever you're watching this video. But I've already included filters here for credit ideas. I've just filtered out for only ETFs. In this case, I'm doing bullish positions. So this would be our bull put spread. I've also included some things you can make changes for your own that are days to expiration of 20 to 45, and then probability of profit 60% or higher. Again, you can make changes to these. You could do 55%, you could do 70%, whatever changes you make. Ultimately, the database and the fields update every single minute throughout the trading day. So I just did 65% or 60% probability of profit or higher. And then I put in an expected value filter of $5 or more. This is a big one for us. We think we should trade positive expected value trades. So I included that here as well. And now from this list, you have a very defined list of potential trade ideas that you can start to explore. So you can see there's some different positions right now available and some different ticker symbols out there. So you can just kind of filter through this list, look at different opportunities here. If we want to look at, let's say, only SPY positions, we could say, okay, well, let's refilter this list down to SPY. Or you go back in here and say, let's look at XLU positions that are bullish that I might want to get into. So again, this is a great way to not just kind of guess and shoot from the hip and kind of randomly throw trades into the market, but to kind of pull up trades that make sense right now. It's a different experience, a little bit more of a shopping experience for trades that fit your criteria, which is ultimately what you want. Now, if you want to find trades on the other side, so now let's look at short call spreads. We're just going to simply click the toggle here for bearish positions. That's going to find all of these short call spread positions. Again, for different ticker symbols, you can kind of drill down here into the ticker symbols that are available. So if we want to say SMH, we want to find all those positions in SMH that also met all of our criteria here. So 20 to 45 days, probability profit 60% or higher, expected value $5 or more, etc. If we find those types of trading opportunities, then we can click on these trades. We can look at the details of this trade. If we like the details of this trade, this one doesn't look too bad actually, then we can get into the position. Just add it to a bot, tag your exit options, make sure that the bots manage them automatically for you for your profit taking, your exits, etc., and you're good to go. So that's really, really quick, easy way to find new trade ideas for both put credit spreads and for call credit spreads. So the other one that we got to talk about, of course, the third strategy that you can trade in IRA is essentially a combination of these two strategies. So that's why I started with those. If you put a put credit spread and a call credit spread together and you kind of mash them together, effectively what you get is an iron condor. Iron condors are great. I love trading them. Trade a number of bots that trade these live. Iron condors are great because you can take in a little bit more premium for about the same amount of risk. And you're trying to basically create a bracket around the market, this range that the market can trade in. And if it trades in that range, you can make some money on the trade. If it trades outside that range, well, that's when you lose. But still, you have defined risk. So again, effectively, it's just the marrying of the put credit spread and the call credit spread. You put both of these together and you're doing a four-legged iron condor strategy. The goal is that the stock stays inside of this range. So if the stock stays inside of this range, great. If it breaks out to either side, at least you have defined risk, which again makes it allowable to trade in an IRA account. So if we look at the iron condor, this kind of mashup of these two strategies, this is what you'd effectively be thinking of. This is what I think of when I trade these, which is that the stock is trading somewhere in the middle and you sell, for example, the 105, 110 call spread. This would be your short call spread or your bear call spread portion. And then on the lower side, you sell the 95, 90 put spread. This would be your bull put spread portion of your trade. You put these together in the same chart, and essentially, again, what you have is you have this out of the money profit zone, which means that the legs of the position are out of the money. The strikes are out of the money. If the stock lands anywhere in here, then the legs do not have any worry about having any loss or taking any assignment or anything. You just keep the premium that you sold for that iron condor. So this is our ideal situation. We want the stock to trade anywhere in this range. It doesn't matter, sideways, up, down, left, right, whatever. As long as it stays in between our break evens, we're good. If the stock does happen to break out to the upside, well, then of course we are at max loss on that side. But again, we're capped on the position. So we're not going to lose more money if the stock continues to go up. So if it goes beyond 110 and it goes to 180 or 450, it doesn't really matter. We're still capped at that max loss again, which is really good, not only just for general trading, but it also makes it for IRA accounts that you can actually trade these in your IRA account. So if you go back over here to trade ideas, you can find these positions by going over to the tab for neutral. So you can use all the same criteria here. You can do different spread opportunities. You can add to this. You can do risk rewards, whatever filters you want to put in here, you put them in there. You click neutral. That gives you your iron condor payoff diagrams here. And this is where you would, again, use those payoff diagrams to find new potential trading ideas. You can see the payoff diagram looks very similar, of course, to the one that we just showed you, which is that nice big iron condor payoff diagram. Sometimes you can find trades that a little bit bearish skewed or bullish skewed if you have a little bit of tendency to go one way or the other, but you can obviously adjust all of these inside of OA and make these positions perfectly neutral or a little bit skewed to one side or not. But again, these are great positions because they are capped max loss. So in this case, this demo example position I'm looking at, $406 of max loss. You can't lose more than that on the position. The stock could go crazy higher, crazy lower, doesn't matter. You have the ability to make some good money on this position, and your probability of profit is about 65%. So pretty decent trading opportunity. Again, you can find these inside trade ideas. I'll put links below this video here so you can check out all of those after you're done watching. As always, I hope you enjoyed this one. If you have any questions on trading in an IRA or any other ideas or suggestions, please let us know in the comments below. And until next time, happy trading.